Hey everyone, welcome to another video, to another training. 4 ways to find additional money from your past year's filings, right? There's 4 ways that you can actually find things on your tax return and go back and amend it and claim back some money. Hey, my name is Boris Musheyev. I'm a CPA and a tax strategist. Every Tuesday, I release a tax strategy video. So if you're not a subscriber yet, go ahead and click subscribe, click that bell icon to be notified when I release a new tax strategy video that will help you pay less in taxes. But now, shall we? Let's proceed. All right, awesome. So 4 ways to find additional money from your past year filings, right? Ladies and gentlemen, what we're going to talk about today exactly is what you can do for your past year's filings to claim back the refund, right? First, the most common thing is missed qualified business income tax deduction. I'm going to talk about that. Owner's health insurance deduction. A lot of business owners pay for their own health insurance deduction and they do not deduct it as a business expense. And if you are deducting it as a business expense, you're actually not deducting it fully. And I'll show you exactly how. Home office deduction. If you're not taking the home office deduction as a corporation owner or pass-through entity because your accountant said it's an audit risk, you are missing out. We'll talk about exactly why it is not an audit risk and what you can do and how you can avoid this and claim back your deductions. Profit and loss on your tax return. Profit and loss versus tax return. What does that exactly mean? Is that how the net income that you report on your profit and loss doesn't equal what's on your tax return, which causing you to overpay in taxes. You guys ready? Let's get right into it. Okay, awesome. So qualified business income tax deduction. Now, what is that? When Tax Cuts and Jobs Act was passed in 2017, as you guys know, the corporate tax rate was slashed to 21%, right? That is for C corporations. But for pass-through entities, there is no corporation tax. There is no corporation taxes, right? So the pass-through entities such as S corporations, partnerships, and single-member LLCs, including sole proprietorships, got what's called a qualified business income tax deduction. It's a 20% haircut. Yes, 20% right off the bat, right? And it's generally calculated from your business income, right? It's really the lower off of your taxable income or the business income. We're going to use business income for the purposes of this video, right? So if you made $100,000, you get 20% of that. You just get a deduction. It's what I'd like to call a checkbox deduction. That means you check the box on your tax return to receive this deduction. But I can't tell you how many times we've caught it with our new clients that come into our firm that their accountant actually missed this deduction, did not check off the box. Think about it. You wake up early in the morning, you're having your cereal with your kids for breakfast. The last thing you should be thinking about is actually auditing your tax preparer, right? So, but what I want you to do, and I urge you to do, open your 1040, right? Your 1040, that's personal income tax return. Look on line 13 of 2021 tax return. Look on line 13, and it says qualified business income tax deduction. See if there is a number there, right? You will be surprised how many times that it could be missed, right? If the number is missing there, you might want to contact your accountant and say, hey, why is there no qualified business income tax deduction? And as a matter of fact, you can go back 3 years and amend the return and claim it. IRS gave you a gift, but a lot of times this gift is just missed by your tax preparer. What I always say, if you have a tax preparer, you do not have a tax planner. You've got to look at these things. You have to plan for it accordingly. Now, why do I bring up planning? Because qualified business income tax deduction enters into what's called a threshold, right? Excuse me, a phase-out threshold. If you're a single individual and making over $220,000 and married making over $440,000, well, guess what? You will not get this deduction unless you have payroll in your business. So a lot of business owners who are pass-through entities, and that could be you own a single member LLC or you're a sole proprietor, you have no payroll and you yourself are not on payroll. And if you're over these income thresholds, well, guess what? You're not getting the QBI deduction. But if you have a W-2 for either yourself or any of your employees, the threshold doesn't apply to you. You're good to go. But you have to make sure that how much am I making? Am I within this threshold? And is my tax preparer capturing this, right? And the good news is that you can go back and amend it. Now, there is an exception to the rule. Accountants, lawyers, doctors, and certain consultants and certain people in certain industries, right, do not qualify for qualified business income tax deduction once their income reaches these income limits, even if they have payroll. So if you're not an accountant, if you're not a lawyer or a doctor, which most of us, that fall into the category could be, right? If you're not that, well, guess what? Even if you reach this threshold, you can still qualify for for qualified business income tax deduction, QBIT. I'm going to refer to it as QBIT, right? You can still qualify for it if you have payroll. Your job right now, open up your tax return, pause this video, open up the tax return, 1040, line 14, and see if you have a number there. If you don't have a number there, comment on the link below, and I really want to know how much would you be amending your return for, okay? Okay, awesome. So I hope this is clear. The next thing is owner's health insurance deduction. Now, here's the thing. If you're a business owner and you're paying for your health insurance out of pocket, if you're a single member LLC, a sole proprietor, or multi-member LLC, and you're paying it out of pocket, well, guess what? IRS says, listen, brother, or listen, buddy, you can still take this 100% deduction even if you pay out of pocket. It comes as a surprise to a lot of business owners, okay? If you're paying for your health insurance out of pocket, you can 100% deduct it as a business expense, and the deduction goes on your personal income tax return, okay? If you take a look on your tax return, Form 1040, there's a line item, I think it's Schedule 1, it should say self-employed health insurance deduction. Even if you have employees, that is where that number goes, all right? If that number is not there, you're missing out on that deduction, and you can amend your prior year return and actually claim that deduction and take it. Now, if you are an S corporation owner and say, no, Boris, don't worry, I've been deducting it, everything is good, look on that line on your personal tax return. If it's not there, you're most likely not including it as your W-2. As more than 2% shareholder, owner of an S corporation, if you include your health insurance premiums as part of W-2, guess on what else you will be saving? On payroll taxes, all right? You will be saving on payroll taxes. Hey, you can, whatever money you'll save based on that, you can go out for dinner and have a really, really nice dinner, right? But anyways, all jokes aside, definitely check. Now, what can you check right now? First of all, fix this mistake going forward. If you're an S corporation owner, pull up your W-2 and make sure it is in box 14 and says 2% shareholder health insurance. If it's not there, you're overpaying your payroll taxes. A lot of business owners do not know about this, and a lot of tax accountants don't do this for their clients. Because look, when you have a tax preparer, you do not have a tax planner. This is a tax strategy that needs to be done during the year, not after the year is over. Because once the year is over, the payroll tax returns, the W-2 forms, everything is filed. You cannot undo this, right? So you want to make sure that you do this during the year. If you are a single member LLC, a multi-member LLC, that means you have an LLC with partners and a sole proprietor, and you never deducted health insurance on your personal tax return, well, guess what? You can, and you can go ahead and amend it, all right? Hopefully this was helpful. If you have any questions, put it in the comments below, okay? Now, home office deduction. Here's the thing, right? You can be like, my accountant does not take home office deduction. My accountant doesn't tell me anything about the home office deduction. And my accountant tells me I'm going to be audited if I take the home office deduction. The truth is, ladies and gentlemen, you will not be audited. Have you heard of COVID, right? Have you heard of this thing called coronavirus? Did you hear that the IRS agents were working from home? They are well aware that people work from home, okay? Now, the whole thing that you get audited if you take home office deduction, that's 1980s, all right? We are in 21st century where most of us work from home, okay? And you can qualify for home office deduction, and you can take a home office deduction. Even if you have a work location, let's say you're a doctor or a lawyer or an accountant like myself, and you have an office, the IRS still lets you take a home office deduction. It says, all right, the rule goes like this. If you're doing your administrative tasks at home, such as billing, invoicing, or any type of administrative tasks at home, and most business owners are, they come to work to get the job done, right? And then when they go home at night, they put their kids to bed, they have their dinner, they settle in, whatever it is, they sit down for a few hours at night, a few hours in the weekends, and do all of their admin stuff at home, whatever it is that needs to be done. Pay the bills, do the invoices, right? Do the bookkeeping, run payroll, whatever that is. Most business owners do that. And because they do that, it's called, the IRS considers that location where you do the administrative stuff as a principal location of your business. That means it now qualifies for home office deduction. That means from now on, any expenses such as your mortgage, rent, utilities, insurance, internet, maid services, you got a cleaning lady coming to clean your home, is she cleaning your office? All of that becomes tax deductible, right? You can reimburse yourself for these expenses and take 100% deduction for the use of your home, okay, for whatever it is, that portion. So for example, if your home office is 10% of your living space, right, then you can deduct 10% of expenses, all right? So if it costs you $5,000 to maintain your home a month, mortgage interest, utilities, all these other things, 10% of that is deductible per month. Over a year, that's $6,000 in tax deductions that you can create for yourself, having a home office deduction, all right? So if you have missed home office deduction on your Schedule C, if you were a sole proprietor or single member LLC for prior years, you can go ahead and amend it. If you are a corporation, you cannot go back and amend it. But going forward, you should be reimbursing yourself, okay? Set up a proper reimbursement plan and reimburse yourself for your home office expenses. Really, really, really important, and delivers great deduction. We do it for all of our clients. And this is part of the tax planning, ladies and gentlemen. If every year you are frustrated about your tax bill, if every year you are frustrated about the deductions that your accountant does not let you take because your accountant puts the right numbers in the right boxes, that is because you have a tax preparer and not a tax planner. If you have a profitable business, I can guarantee you right now you're overpaying in taxes. Take advantage of tax planning. Take advantage of paying less in taxes. Let's continue. Profit and loss versus the actual taxes. And what do I mean by that? I can't tell you how many times I was surprised when I take a look at clients' last year's profit and loss, and then I look at the tax return. And the tax return income, the taxable income for the business is more than the profit and loss. Now, I understand some accountants have to make some adjustments and disallow certain expenses, because they don't make sense. They belong on a balance sheet or whatever that is, or some personal expenses were claimed on a profit and loss statement. They can't be deducted. All of that remains true. Sometimes in my firm, we also make adjustments that increases the net income that the client gave us, and the taxable income is higher. But you will be surprised how many times actual deductions were missed from the profit and loss statement on the tax return. So when you are receiving your tax return from your tax preparer, when you're receiving that tax return, you want to make sure you take a look at the business taxable income. In my firm, when we finalize a business tax return, the tax preparers that work here have a call with a client and say, hey, I want to review your business tax return. There were adjustments made to your profit and loss, and these are the adjustments, and this is your new taxable income. You always want to audit your taxable income against your profit and loss and bring it up to your accountant's attention. Be like, hey, why is my profit and loss different on my taxes than on the profit and loss statement, right? Meaning to say, what I meant to say is that why is my taxable income different than what is the net income reported on the profit and loss? Question, find out, and you'll be surprised with the answer that you will be getting. Sometimes accountants disallow certain expenses because they assume that that is a personal expense. And the motto in my firm is that never assume, always ask, right? So you also want to ask your accountant, and then your accountant like, oh, I thought this was personal. Oh, I apologize. Yeah, let me put it back, right? So always check your taxable business income. And guess what? If this happens to you for the past 3 years, you can amend the return, claim back the deductions that your accountant missed, right? Always ask for adjustments from your accountant or bookkeeper. Hey, did you make adjustments? Did I misspell bookkeeper? Wasn't it supposed to be 2 P's? Oops. Anyways, ladies and gentlemen, and I conclude today's video. If you like what you see, I release tax strategy video every Tuesday. Click the subscribe, click the bell icon to be notified when we release the new strategies. And thank you again for watching. And until the next time.